Okay, good afternoon, everybody, and welcome to the first of the IMAP webinars for 2020. Happy New Year to you all, and it's going to be a pretty important year in the advice industry, and that means that for managed accounts, it's going to be a critical year because managed accounts really are implemented advice. In today's webinar, we're really going to talk about one of the fundamental building blocks of advice and managed accounts. We're going to talk about models, and we're going to do that with two of the leading participants in this area. BlackRock, the world's largest fund manager and a keen and very active provider of models to the advice community, and Praemium, absolutely one of the first participants in the platform world, and an organisation for whom portfolio management and model-based management was at the heart of what they did. Now you should be able to hear us. I've got a chat from Amita saying I cannot hear the webinar at all. Is that Amita, that might be a problem for you because the other participants are reporting that they can hear. So that brings me to the next point. As we go through today, you are welcome to submit questions as they arise. In the bottom of your screen, you'll see a little button for Q&A or chat. You'll probably find chat is easier to use, and each of the presenters will see those. We'll see your comments or questions. Sherry, I see you've raised your hand, so if you want to submit a question through the chat, that would be great. Okay, I can hear all good. Great. Well, look, before I ask our two presenters to kick off and talk about models, I want to talk very briefly about a couple of the regulatory issues and a couple of events that IMAP will be holding in the first part of this year. So firstly, two important regulatory initiatives, one of which has been sprung on us pretty much at the last minute. So those of you who've been watching our webinars and our EDMs through 2019 will know that ASIC have been conducting a platform and MDA review, and I wanted to give you a very brief update on where that's up to and how we see that playing out through 2020. Through 2019, ASIC spoke with a number of participants, sent out a number of formal questionnaires, have compiled an internal report. In probably the second quarter of this year, we'll see draft regulations come out and a consultation period. IMAP will be providing a consultation submission, and we'll be inviting you to participate in preparing that submission. It'll predominantly affect MDA users, but there will inevitably be some flow-on consequences for those who are involved with SMAs or other forms of managed account, either as portfolio managers or as advisors. The other thing which I wanted to give you a brief update on the 20th of December, 2 days before Christmas, Treasury issued a consultation paper on the compensation scheme of last resort. So this arose from the Royal Commission and from previous work that had been done, where compensation was awarded by FOS, now AFCA, or by a judicial process or a tribunal, and that compensation was not paid. The Royal Commission endorsed the creation of a scheme of last resort to be funded by industry participants. The consultation paper, which was issued a couple of days before Christmas, sets out a set of questions about how that compensation scheme should be funded, and importantly, how large it should be. My own view from reading it through is that their estimates of how large it should be, $10 million, woefully inadequate. in the event of a catastrophic failure of compensation. The submissions are due by the 7th of February. So, to issue something 2 days before Christmas, looking for considered submissions by the 7th of February seems to me to be pretty poor form. IMAP will be compiling a submission, and we will over the next day or so send you an opportunity to give us your feedback on how that compensation scheme should be funded, how large it should be, and issues which affect advisors, product issuers, platforms, fund managers, credit issuers, all of whom are caught under the requirements of the scheme. But 7th of February is when the finished submission has to be submitted. Now let me just touch briefly on a couple of upcoming events. So 6th of February, we're running an investment forum luncheon. So global equities portfolios is a key topic now. Markets are fully valued. And so we've invited Zurich, Mercer and BetaShares, each of whom has a unique perspective on global equity markets, to present on how global equity portfolios can be managed or ought to be managed in a managed account context. It's a concurrent session in Sydney, Brisbane, Melbourne, Adelaide and Perth, kicking off at 12:45 at Sydney time, same time videoed, and it's a video presentation across all 5 centres. We do these 4 times a year, and I'd encourage you to come along and attend. But more importantly, the Advisor Roadshow in March. So managed accounts are implemented advice. And the Roadshow is an opportunity for us to draw the threads together of advice businesses, creation of advice, and the use of managed accounts. This year we've coined the theme professionalisation, what it means for advice businesses. And every topic in the Roadshow this year speaks to this issue of professionalisation. FASEA and the Royal Commission have said you're going to be a professional if you're an advisor. But what does it mean to run a professional services business? What does it mean to run a business predominantly delivered by professionals? What does it mean to conduct all the operations and processes within that business in a professional way? And the Advisor Roadshow really tries to pick up on that theme. So some of the topics, for example, Paul Barrett from AZNGA will be known to many of you as one of the key owners of advice businesses, over 50 practices now in the AZNGA network. What is professionalisation? What does professionalism mean to Paul and AZNGA? How do they assess professional advice practices? Paul has very strong views and will be a keynote speaker. Praemium, Damian is one of our presenters today. Praemium will be talking about research which they've run on the profitability impacts of managed accounts. We'll have a session on professional management of portfolios in a licensee context. We'll have a session on ethics and managing clients' requirements. I suspect many advisors are coming back from holidays to find a voicemail from clients saying, I've been thinking, I was watching the bushfires on television. I'd like to come and chat to you about my portfolio. How do you respond to that? How do you integrate both good advice practice with what a client feels is the way the portfolio ought to be managed? Other topics will be case studies in best practice within advice businesses. I'd encourage you to come along to what for us is one of the central events that we run each year. So in today's session, as I mentioned, Damian Cilmi from Praemium will be presenting on the experience that Praemium has had. Damian's role within Praemium is responsible for the compliance and approval, appointment of and monitoring of model managers for Praemium's separately managed account business. And so he'll be talking about what they see as the use of models and the role of models, followed by James Waterworth, an investment specialist from BlackRock, talking about BlackRock's view of models and how they construct models for advice businesses. I'd encourage you to ask questions as we go through the chat function, and I'll facilitate those to our two presenters. So Damian, please take us away.
Thank you very much, Toby. Thanks for having me. So this morning, I just really want to set the scene about a lot of discussions with advice practices and why managed accounts is really just an outcome of many of the fundamental points that I want to talk about within the advice process, and obviously trying to make it more efficient and scalable and so forth. And as Toby touched on, whilst my role is to monitor, review and approve model managers for our SMA program as responsible entity for Praemium, I also spend a lot of time with advisors, either talking about how they can utilise managed accounts within their business, or, as James will go and talk about later, is potentially build their own framework as well, and working through with them about what it means to run an investment program, what the expectations are of us as responsible entity, and how that all can be done. So next slide, please. Yeah. So again, I just want to outline some of the background, and then James will really get into the detail of how it all gets applied. And so we're talking about investment risk, but fundamentally, I want to start talking about, which many of you know about, which is around the advice process there. And as we'll talk about, the investment solution is really the last piece of it. So let's go to the start. And so a lot of it will, just touch on quickly around investment policies at licensee land and monitoring those outcomes as well. So next slide, please. And so when we start with this here, it's worth remembering during that advice process, we're doing a lot of predominantly return profiling is probably one of the key elements of it, because it's around meeting the objectives and goals of the client. I have $500,000 today. I want to retire in 10 years' time with $1.5 million. So let's solve for X as to what return is needed in order to meet that retirement objective. So, that's a key one. It's overlaid with risk profiling. And the other extension that we're seeing is these days more goal-based portfolios, and I think all of those can be catered for within many investment programs. And so when we think about that return profiling, and let's say we've determined that you need 7%, 8% per annum in order to meet those investment objectives. The dealer group sets certain parameters to say have a reasonable basis in order to what they believe that this structure will deliver 7-8% per annum over the foreseeable period. And that's typically documented through asset class assumptions, starting Aussie equities, global equities, working our way through, and then typically weighted, as we know, into risk kind of risk-based profiles, defensive, balanced growth, etc. A key component within that financial modelling, again, a key component in the advice process, really the most fundamental part of it. And as we'll go to talk about, really the investment solution is the implementation of this framework here that we're talking about. So next slide, please. And as I said, we're talking about these reasonable assumptions. Licensees spend a lot of time documenting these asset class assumptions. and having a defendable and reasonable basis as to why there's a belief over the forward period that Aussie equities will return 10% per annum and bonds will return 3% per annum, and therefore on a balanced portfolio return 6% per annum. So we see that to be a very key part. Next slide, please. And this is for illustrative purposes only. And so this will end up formulating into these risk-based portfolios. We're just using this as an example. And I suppose that the key thing is, you know, down the bottom is the asset classes or the forecast of returns and the volatility which gets utilised within modelling. And a key from a licensee perspective in managing this investment risk, managing this kind of client risk, is ensuring that that balanced client has certain parameters around it in order to meet that target return objective. And that will be, you know, Australian equities around 19%, international equities 19%, etc. There will be some tolerance being put around that, typically at a licensee practice, again for illustrative purposes. There might be a tolerance band of plus minus 10%. So really now we're getting into the real heart of what's going on from an advice practice, how these assumptions are incorporated within the advice process, and then you know, some of the policies that are around it. So this is a key part now. Now we're actually getting to the implementation side of things. We can set, you give me $1 million today, I can go and buy those weights at, you know, 19%, etc., etc. But now we have to monitor it as well too. And so we're going to have drift in it, where there could be certain cash flows or certain things that there's adjustments made to it. But the key part still within the advice, the licensee and the advice process, is to have that rigor around that balanced client being within 19% in Aussie equities. This is the key thing that we're always solving for. Next slide, please. And so there's a lot of tools that are out there at the moment. Explain even with our own platform as well, that you can target weights and monitor on a lot of these things. Now, this I suppose investment program that I'm talking about, within platforms allow you to have like a standard weight. It can have periodic rebalancing automatically incorporated within the platform. So there is some comfort around the advisor and the licensee that when the money's put in on those weights, that all things constant, they could get rebalanced quarterly back to those neutral weights. So I suppose the key thing about that there is it really only works in that kind of environment for what we'd call the strategic asset allocation approach, and that is fixed weight investment policies. And so whilst that part might be okay, we've found that SAA approaches have become less desired. People have very much wanted to run far more active asset allocation programs, both at the asset allocation level and then also at some more granular security level. Next slide, please. And so what we're seeing out of this is now the dilemma, which is I need to monitor for those kind of weights, but I want to get a lot more active in either overweighting certain asset classes or underweighting them for certain reasons. And then how do I do that in a scalable process? So now we just get into the heart of what many of the issues are, and the massive dilemma. And anecdotally speak to a lot of advice groups, we see a lot of portfolios and models, come through. And, I must admit, active asset allocation programs, and we've seen very much in the last couple of years what we call dynamic asset allocation programs, which have got probably a lot more wider bands, and philosophically the expectation that those bands get utilised and moved fairly aggressively. because we've, either feedback from clients has been, people didn't want a repeat of the GFC. Couldn't you see it coming? Well, why didn't you position a bit more defensively? Or, you have very specific events, maybe around, classic one was around a European debt crisis. A lot of people wanting to navigate portfolios away from Europe. And then in the recent past is we've seen a lot of active asset allocation positioning around concerns for rising bond yields. Now, that's been a very challenging one, as we've all seen, where it's a kind of wax and wane, where yields have actually fallen, for a large part of 2019, really the kind of last last month or so. And so now we've got a situation where we're seeing a lot more active asset allocation programs in play. But how do you deal with it within your business? And obviously, every time there is an active asset allocation change, it is an advice event. And so at a minimum, we're talking about, an ROA being sent out to hundreds of clients, if not thousands of clients, in order to say, okay, we are now going to underweight Aussie equities from 19% neutral down to 16%. Doing that, and it's costly work for groups to implement. Very rough numbers of $100 to $200 between the production of the individual piece of advice, individual analysis at times as well that needs to occur, and then just paper or authorizations coming back from the client, and then implementation typically on platforms or whatever vehicle that will be utilized. And there are a number of challenges that advice groups face with making a large contact to hundreds of clients. At times there's priority issues about who I contact first. It's not necessarily easy to do it equally across all clients. Waiting for those authorities to come back in, there's a lot of slippage. Anecdotally, a lot of firms will say that they'll lose anywhere from 10 to 30% of clients won't send back authorities. And so now we've got portfolios that are all, somewhat misaligned. And then we've also got those authorities coming back very much at different times as well. So the trades are getting implemented at different dates. And probably the key part out of all of this, between the slippage, between the implementation dates being all different, I can have clients that are notionally balanced clients, with a similar starting point, but their return experience may be different because of these factors here. And then that does make it a lot harder for advisors to communicate in aggregate about what's happening with portfolios, what were the major drivers of returns, because now we've got portfolios that are all slightly different, and those returns won't be necessarily representative of the kind of aggregate communication or portfolio returns that are going on. So these are very much many of the dilemmas that are going on with advisors, the pain points, and looking for a solution to solve for that. Next slide, please. And it just where this kind of culminates is around managed accounts as a collective term, and that could be within MDAs as well. And they're still very heavily utilised. And we've seen in the recent past the rise of SMAs in particular as a vehicle to mechanise the investment programs. And James will go into a lot of the detail of this here, but deal with a lot of the pain points. Clients all trade at the same time because the implementation is only done once and it hits all the clients at the same time. No ROAs because they're inside the structure. It's a portfolio management decision akin to what it would be if they were in a multi-asset fund. And then again, another thing that we're seeing a lot, it's kind of very much a liberation, if you will, where we've seen, because of the ability to trade at the pool level, if you will, the ability to take far more granular approaches within portfolio design. And we've seen that very much within the fixed interest space. I think that's been an area where people have got a lot more granular than what they used to be. You know, we go back 5-6 years ago, it was 2 or 3 DFI, diversified fixed. Don't know, a bit hard, whatever, hard to implement, hard to make changes quickly. So we've seen a lot of amendments to that. So I'll just stop it there and we'll hand over to James.
There's a question come in, Damian, from one of the attendees in talking about Praemium's policies around what's required for a licensee who wants to run their own portfolios or wants to have portfolios run for them. And do you want to talk a little about that?
Yeah, sure. There is that slide there. I'll make some quick observations. So there is what we call buy, partner, or build. So buying is, so we have 300 and 350 managed models already set up on the platform, many multi-asset ones. So we have BlackRock iShares ones, for example, risk-weighted ETF portfolios. That's something that someone could go and buy off the shelf today. And then on the opposite end of the spectrum would be an advice group building their own capability. So the key part about that is we as RE, that's a responsible entity appointment, we expect a lot of rigor in the investment program and capability from the group proposing to be approved for models. I suppose some of the key points that we've got there, organisation, regulatory, governance controls in there, and that's both because of the AFSLs are a very critical part. I won't get into the detail of it, but we face an AFSL and receive instructions from them. So we spend a lot of time working on how good and how much rigor there is from a compliance point of view to start with, because we don't want to see anything happen to that AFSL. And then working through the key things that you would think about if anyone is selecting a managed fund, for example. So, you know, parent, people, process, performance, and we spend a lot of time working through there. The expectations on there is that, you know, we would want to see not just one person. You know, there's a lot of key man risk, so we will see, is there a team there? Have they been running similar strategies in the past? Even if it was on a paper portfolio, some evidence that the process has been in place for some time. We can understand the process and we can see what's going on with the performance as well to get some idea on the quality of what's going on. So that's just a quick overview on that one there.
Okay. Now there's a question here, Damian, about this slide here. The question: can you explain the term UMA blended solutions? This combination of MDAs and SMAs.
Yes. So this is we're seeing more and more of this where platforms are becoming a lot more understanding of the fact that not everything is going to be held on platform under custody, if you will. And we've seen greater developments of holding assets not on platform, not on custody, in a non-custodial manner there. So we have a lot of setup to report and provide portfolio analytics and global view on clients' holdings within or outside of custody. The other thing that we're seeing as well is the integration of MDAs and SMAs. They're not mutually exclusive. We're seeing them being utilised side by side, where we might have an Aussie equity SMA for that leg there, and that's purchased, if you will, as a line item within the MDA, and then the MDA is doing some other bespoke stuff for the other asset classes. So what we're seeing is a lot of different structures being utilised, and we're, as a platform, and just speaking personally with us and, some of our competitors as well, we're having to bring through a lot of disparate pieces of information and unified, if you will, from different vehicles, and to present the total client picture.
Okay. Now there's a question come through here. Well, there are two, which I'm going to touch on. So firstly, are you able to provide any comment on how much you'll need to run your own SMA or MDA for that matter? And is that for both super and IDPS? So I don't know whether Praemium has a policy on that. I've got a view, but you go first.
Yeah, listen, these are just very rough numbers, but I would say at around $20 million a portfolio, I think makes it economic for both sides. The qualification to that point there is that we have a lot of people that would want to do risk-based profiles. So that would be, say, 5, defensive, conservative growth, balanced growth, high growth. So in aggregate, that would be, let's call it $100 million across those 5 there. We also appreciate that the tops and tails of those risk profile ones won't be get the majority of the money. Typically, it would be around balance or so balance and growth. So we would kind of look at that number in aggregate and not necessarily 20 million equally across all of those portfolios. But that's just a rough indication.
I'd share that view that if you don't have 100 million to commit to the program over a sort of a year or so, then you can't get there. The other observation I'd make, this is is the costs of being effectively the issuer of the portfolios is rising. One of the outcomes of the MDA and platform regulations could well be capital requirements for MDA participants. The compensation scheme of last
that's true, and that is because REs, currently have that at the moment. So, and that's obviously happening within SMAs.
I can hear.
Okay.
I can hear Damian.
Okay. All right. I can't.
I'm still hearing.
Yourself. We have discretionary and advisory capabilities as well as execution only. So if you're an advisor, you discretionary, advisory, execution only, or you're probably blending a portion of all 3. The other thing that that I'd like to talk about, and Toby, looks like with the slides are back up and running. We're now on the portfolio construction process. I think it was about slide 4.
Here we go.
Yeah, there we go. Okay, we're back up and running. Before we go sort of like into the BlackRock models, we wanted to discuss the portfolio construction process. And what I'll share with you today is a framework. We want it to be seen to be additive to your current processes or a useful guide if you're new to building portfolios. So Toby's very kindly changed pages already, which is fantastic. So this slide, there's 4 boxes on the left-hand side in bright colors, and the acronym is BBIM. And believe it or not, BlackRock in the US has actually trademarked this intellectual property. So this is a real thing, and as I mentioned, we hope it's a thoughtful and well-documented process. And the first thing we look at is benchmark. And what we mean by that is, what are we solving for? So Damian mentioned about risk-based strategies earlier. Alternatively, there's income, etc. So what is the client objective that you're trying to solve for? And then the derivative of that is then what is your growth and defensive splits? The second box down is, once you've got your benchmark sorted, is budget. So how do you evaluate risks and opportunities? And we think about budgets in 2 ways. And the first one is cost. And this is fairly intuitive. We well know that alpha strategies, alternative strategies are cheaper than indexed strategies. So what's the blending of those two elements and others for the overall portfolio cost? The second way that we think about budget is risk. So what is your active risk budget? And Damian talked to, about active management. So when we think about benchmark, and sometimes that is driven by strategic asset allocation, and let's just say it's a 50-50 equity fixed income split. If you go into, if you're bullish on markets and you go 52-48, you may be, that's taking active risk over and above your benchmark. Secondly, if you were to go overweight Aussie equities versus your neutral standing, and Damian have alluded to that as well, that's an active risk consideration. So they're the two elements of risk we think about, is cost. So what's the portfolio cost? But secondly, what is the risk that you can take over and above that benchmark? The third one down, and those first two you can sort of think is your design stage. The third stage is the investment stage. So this is the sort of fun stuff where you can go and meet with people like myself and look to implement your strategy. Whether you want direct stocks, bonds, LICs, ETFs, funds, unlisted structures, etc. There's a huge amount of opportunity out there to build the portfolio. Alternatively, you can also look to implement that strategy via an off-the-shelf model. The last stage is this concept of monitoring. So keeping a hand on the wheel. And I think for the most part, that's quite intuitive when we think about rebalancing as an example, but also how do you measure your managers? Secondly, new strategies will come to markets, new funds, new ETFs, IPOs, etc. How do you incorporate these, as the opportunity set increases? But also your clients' needs may change, and that sort of gets the rotation, if you will, going back to when you meet with your clients again, is to the benchmarks. So next time you meet them, okay, you may have been in a balanced portfolio. Now you're more worried about risk. Okay, let's move you down into the moderate one. So Toby, if we can move to the next slide. And whilst you're doing that, we just had a question from John come through. And the question is, can you talk on the time lags between the managers taking positions and the SMAs taking positions? That's a really good question. So I can talk to our portfolios. So we rebalance formally on a quarterly basis, but we also have the ability to trade intra-cycle. We'll talk about this a little bit later. But we have the ability to trade on any given day, whether that is trading on risk or something we want to take advantage of. So typically what we'll do is we'll have an investment committee. They then make the determinations, and we then send the platforms, the trade files, typically in the morning. And that's, for the most part, usually executed that afternoon. Different platforms will execute differently. Some may do things like VWAP. Other ones will trade at the close. So I think that question, John, is I think when you are doing due diligence on any of your managers, that's just something to take into consideration as to how frequently they meet, whether that be a formal process, and whether they have the ability to trade, over and above those periods as well. But for us, definitely we can do so. And I think that's a large reason you do go down the SMA path, is because the manager that you've selected is making those decisions, whether it be looking at on a very frequent basis. So on the next slide, at BlackRock, we're sort of uniquely positioned in that we have a very large ETF business, and obviously everyone's very familiar with iShares. But we also have very significant active and alternatives business as well. So I think we're well placed to say this. And what we believe is that there's no such thing as a passive investment decision. So we don't really like the terms, and we actually prefer indexed, factor, and alpha. So every decision that you make is active. So if you get paid cash into your bank account, the decision to leave it there or to move it on into or allocate it elsewhere, that's an active decision. Things like asset allocation, dynamic management, so are you reacting to events, etc. Those are active decisions. Obviously, manager and security selection. So if you're stock picking, are you fund picking? That drives a lot of returns. And so too, as to how you then implement as well. Are you trying to trade on momentum, etc. So next slide, please, Toby. Okay, so the next slide, and it's got a bit of, whilst I'm sort of waiting for this to populate, is everyone sort of have a look at the little map on the left-hand side, and if you have a sort of a little bit of a guess as to what country that is. It's going to be a bit of a rhetorical question because it's not a live sort of talk back to me. So hopefully you all got it right. The question was, what country is it? And the answer is Norway. So Norges Bank is the sovereign wealth fund of Norway. It's the relevance of that is they have commissioned 2 studies, which they've done. It's the same one effectively, but they've done that now twice, whereby they've looked at their portfolio and to the determinants of the risk and return characteristics. And they commissioned a panel of professors, so independent of them. And what the Norges Bank found was that 99.4% of the risk was explained by the benchmark choice. So your decision to be into a certain amount of Aussie equities, US equities, equities versus fixed income, etc. That is the largest determinant of your portfolio risk. They also found that active was very much meaningful, and that it added about 0.2, and of half of that was driven by factor returns. A bit closer to home on the right-hand side, as we have an IFA located here in Australia, and I'll explain it to you because it's a little bit tricky to sort of intuitively read at first glance. On the horizontal axis, you have time, so starting in January 2012 through to January 2018. And on the vertical axis, you have rolling 12 months return for a balanced portfolio for this particular advisor. And this is some work that we did for them. In green, you can see the strategic asset allocation return. And in gray, you can see the selection return. So how much value did the, or alpha did the active managers and the stock picking add over and above the strategic asset allocation? So what you can clearly see is that the active strategies added value, particularly January 12 to January 14, and then July 15 to January 17. So it was a little bit lumpy. But what really drove this particular portfolio at this particular time was in green, was the strategic asset allocation return. So what asset classes were they invested into? Thanks, Toby. Next slide.
Just before you move on from that, James, so I presume that this is relative to a neutral. I was looking at these slides earlier on, and I assumed that this is relative to a neutral stance in the asset classes that are involved in this portfolio. Is that a correct assumption?
So it's not looking at it's not. So for example, if you look at say January 2014, you see a 20% return. What that is saying is that for the year prior, the portfolio, if you were the balanced portfolio, you would have had a 20% return. It's not saying that the SAA added value. And then at that time, January 14, the alpha was negligible. So it looks to be maybe even slightly, tiny bit negative. So it was wholly driven by that strategic asset allocation. So we haven't looked in here into TA, etc.
Right. Now there's another question come through on transactions for buys and sells. We might come back to that at the end. Also, when we lost these slides a few minutes ago, we also lost one of the questions which was in there, which I was going to come back to, concerning SMSFs and cash. So to the person who submitted that question, if you want to have another go, we'll try and pick it up as we get towards the end. So, but let's move on now to the next.
Yeah, fantastic. Yeah, thanks, Toby. So we'll shift gears slightly. So I think we've provided a little bit of context about the regulatory and changing dynamic that we have in the Australian wealth management environment, and secondly, the importance of you having a portfolio framework, and the second is building a models-based practice. And it looks like my power is actually running out of my user, Toby. So if you maybe pass that question through to Damian on the SMSF and cash, sure. And I'll just make sure I plug in my computer correctly. Apologies.
Yeah, so Damian, the question, and this really does speak to the platform experience, which is on some SMAs, you see a lot of transactions that are buy or sell small positions. What are your thoughts on minimizing trades, and what effect does it have on CGT for an SMA? Yeah. I've got some thoughts on this, but you go first.
It's not a perennial question, but it's about trying to get an optimal balance out of all of this. So effectively, you've got a continuum, and that is, you know, how closely do you want every client to match the master portfolio, the shadow weights, the target weights, and some along the spectrum do want to have near perfect alignment, and what that will mean is that there's a lot of correcting trades. So every day, and in our system does this, it's our platform, that effectively it goes in and says, okay, BlackRock iShares ETF models got 15 securities, and here are the target weights. It goes to search for every client tagged to that model, and it goes to compare the client's weights against the master model weights, and it's doing that assessment every day. Even if the model hasn't traded, it sees if there's any imperfections that it can kind of close out. And imperfections will always exist based on, you know, transaction, trade price, etc. Timing issues as well can occur like that there. So these are always there. So it becomes a greater concept of, do you want more perfect alignment so you know your clients are all very tightly aligned to that model and therefore getting the performance intended by the manager? Or do you want to slow down some of that noise? And what you have to go to accept is that you will get deviation in the portfolio. So this, we take a certain sense, we're more closer to, we want closer alignment rather than slowing it down. But there is some capacity as well at the advisor level to put some settings on there to raise the minimum transaction amount, and that can have the effect of slowing up some of those trades.
Yeah, my own view in the management of portfolios is that clients will see transactions in their portfolios which they would not otherwise have seen if they were simply seeing their advisor twice a year to have a review and rebalance experience. And so while it might not, and most managed, or many managed account programs aren't rebalanced on a daily basis, but even where the rebalance process is relatively regular, clients will see trades. What you want to avoid as an advisor or a portfolio manager is the buy, sell, buy trade, because that is just noise. But there will be smaller trades, and particularly where there's active portfolio management or active transaction management. It's actually a positive thing to be able to say to the clients, well, we believe that this stock was well priced, or this market was well priced or overpriced. Because we believed it was overpriced, for example, we eased our position in it progressively over time. And that's one of the benefits of the managed account. We were able to buy in stock at a price we liked, or ease our position out because of our feelings about this market.
Yeah, agree.
So let's move back to James now.
Thanks, Toby, and apologies, for that. I was plugged in, but it didn't have power, so I had to scramble and find another PowerPoint. So anyway, I'm back. So now I'm going to shift gears and now focus on the benefits of building a models-based practice. I can see some questions coming through, and we can obviously take a lot of those at the end. So when we think about it, and Damian talked to many of these, and the first point is to scale and simplify your practice. And this is about streamlining the investment management process. And Toby said in his opening, all that a managed account is implemented advice. So it allows you then to spend more time on strategy to add value, and rather than, as Damian mentioned, trying to chase people on their holidays for ROAs, etc. The second one is on the fee management, and I guess this is through scale. Whether if you're doing it yourself, you have the benefit of being able to potentially negotiate fees. You may be partnering with asset consultants, etc. How to have those contacts with fund managers and be able to do that in aggregate as well. And really, what it all boils down to, and this is the most important point, is the last one, is of the three points I've made here is that implementing a defined investment process is by far the most important. In that all clients get treated equally. That's what Damian mentioned, that when there is some sort of event that you are trading on, all clients will be traded at the same time, at the same price. And it also allows the model manager, because of this framework, to respond to markets. So we can trade all the clients simultaneously through our platform partners. Secondly, and Damian made this point, is imagine you've put your client into a balanced portfolio. Given that there's no ROAs ongoing, we are able to rebalance that portfolio so it stays true to label. The next slide, please, Toby. So what's the upside for you as an advisor? And this is an investment trends report that came out about 2 years ago in 2018. And what they did is they looked at advisors before and after adopting models. And what you can see is, and we've talked about, I won't go through all the points, but what you can find is that on average, they found that advisors saved approximately 12.5 hours per week. So that's 1.5 working days that it gives you back. And how do they do that? How they find that time? The reason is that you obviously save a lot of time because you're not keeping as up to date with markets as you were before, because you've obviously outsourced a portion of that time. You're not generating things like reports, investment administrative work, etc. So you get a lot more time back. You get a lot of capacity freed up in your back and middle offices to provide additional services to your clients. Next slide, please, Toby. Damian made this point, and we're not dissimilar. We have this concept of build, buy, or blend. So just like there was a spectrum earlier, whether you're from discretionary through to advisory, when you're actually looking to implement portfolios, there is a spectrum. From on the left-hand side, you have insourcing risk. And what we mean by that is you're 100% building it yourself. So that's your DIY option. And on the right-hand side, you have outsourcing risk. And that's whereby you buy it from a model manager, such as yourselves via platform. This is your off-the-shelf solution. What we tend to find is quite common with the advice practices we talk to is that you'll probably do something in the middle, this concept of a blend of the build and the buy. So an example would be, you might say, you know what, someone like a BlackRock is really good at equities and bonds, so I'll outsource that portion of the portfolio to them. But I want to, as an advisor, add value through some satellite vehicles that may not be within that particular model manager's framework, infrastructure, alternatives, hedge funds, etc. So you can add that value and level of bespoke to your clients. Secondly, from some advisor practices may tier their clients. So for their large H&Ws who expect to have that sort of DIY service, they may build them bespoke portfolios. But then, if they have, children or some friends, etc., then you may want to have an outsourced solution for lower balance clients, as an example. Next slide, please, Toby. So building on this is that at BlackRock, we have some insights as a global third-party manager. So here in Australia, we manage approximately 1 billion Australian dollars within our model portfolio business. And in the US, it's obviously far, far larger than that. So the insights that we've gleaned are as follows. One is what we find is that clients and advisors like a simple solution. And when I think about simplicity, I don't want to be confused with being basic. So we all have, smartphones, and they're very intuitive. They don't even come with instruction manuals anymore. They're very intuitive to use. There's obviously an incredible amount of engineering that has gone behind, in the background to ensure that it's world class. It does what it says on the tin. So I want to be a simple solution, but not a basic solution. The second concept is this of a steering wheel. So when we're all taught to drive, we're all taught to keep our hands on the steering wheel, eyes on the road. It's the same concept here. So the strategy, given that you're outsourcing it, and you want to have the benefits of being in the managed account framework, is you want the strategy to be market aware. And then, there's obviously a multitude of, products out there that you can select, whether they be dynamic or strategic asset allocation, and obviously that then in turn impacts their ability to respond to markets, etc. The third one is, should save clients, money. Given that you've outsourced it and that person is aggregating that solution, you would hope that it'd be cheaper than doing it yourself. The fourth point is superior investment performance. And this is ultimately why you are outsourcing that to a qualified investment manager, is that they should be providing you with fantastic investment performance. And the last point is this: we have this concept of surround sound, and it sounds a little bit fuzzy. And what we mean by that is, when you outsource to a model manager, what is the level of service that they are providing? So I can only talk for what we do, but the things that we have is we have monthly and quarterly commentary. Upon a rebalance, you'll receive a flash update of these are the trades we've made and why we've made them. We have risk analytics. We have on our website, we have things like we're Lonsec rated, and we have client videos, client brochures. We have flyers, SOA inserts, all these sorts of things. This is what you can expect from a model manager, and also you should ask them how they can support you, whether it be presenting to your clients, etc. Providing updates on an ongoing basis. Next slide. Thanks, Toby. Okay. Whilst I'm waiting for the slide to change, what I might do is I might even skip this slide, Toby, just in the interest of time. This is what our portfolios look like, and I guess here's what we're talking about for managed accounts. And I won't go through it in detail, but for any managed account, given you're on platform, you'll see all the holdings. This is the benefit of a managed account, is you have incredible transparency. You will know exactly what you hold at any given time by logging on to your platform. Next slide, please, Toby. Okay, I might skip this, but I think for any model manager that when you think about it from a due diligence perspective, is that they will have a strong framework of how they've determined their strategic asset allocation and what value they're adding over and above that through tactical or dynamic allocation, fund selection, etc. So Toby, I think in the interest of time, we may leave it there, and we can go to questions.
Okay, well, there's a couple of questions which have come up. I mean, one of these is the integration of licensee views. So there's a question here about which I guess spoke to grew from this slide. How does BlackRock then integrate the views that a licensee who's sort of commissioning the portfolio might have, for example, on currency or on alternatives or on the blend of active and passive?
Yeah, sure. So I think every model manager is different. For the models that we've shown here, these are our off-the-shelf models, so there won't be really any consideration for the licensee view, given that these are off-the-shelf. However, that said, through the platforms, what you can do is, this is the same for any model manager, is you can do exclusions, etc. So you can sort of tinker with the SMA, if you will. Taking a step aside, whereby we do bespoke portfolios for clients, of course, through that design phase, we spend a considerable amount of time doing that. The portfolio we've shown here is ETF only, but of course we can do other strategies, other structures, etc. as well, and open architecture. So I think that really is just a horses for courses, Toby. So what I would say is, if you are buying through a platform and it's off the shelf, then that's what you're buying. Even though you have a slight ability to tinker with it. Alternatively, if you're looking to build it yourself or to partner with an asset consultant, fund manager, etc., that's whereby it's more of a collaborative experience.
Okay, thanks very much, James. So, Damian, is there anything in summation that you'd like to wrap up with?
It's challenging for advice groups, and they're constantly looking for ways to optimize this implementation of the investment piece. There's a lot more focus going on at licensee levels as well to make sure that advisors and clients are in the respective portfolios and monitored within their policies. I think the events of the last couple of years have really highlighted some of the compliance risk around investments. We haven't even seen probably the worst of it. It tends to come out a lot worse when returns are very, very negative, and everyone will go and see if there's been any slippage, from investment program point of view. So I think the licensees again, quite vigilant on making sure that client portfolios are within frameworks like that. And then the challenge of having to monitor it, but then also do it within a active asset allocation or active security selection kind of basis, and that's where managed accounts really come into their fore.
I couldn't agree more. We've operated in a very benign environment, and as Warren Buffett said, it's when the tide goes out, you see who's been swimming without shorts. So I hadn't thought of managed accounts as the swimming trunks of financial services, but
there you go.
Look, thank you very much, everybody who's attended this. On the screen, you should see the next upcoming events, the investment forum lunches on which focuses specifically on global equity investing, but more importantly, the advisor roadshow. What does professionalisation mean for advice? Thank you very much, and we look forward to you joining us at future webinars. We'll be sending CPD points to those who attended this, so there'll be an hour of CPD associated with this webinar. Thank you, and we look forward to you joining us again.
Thanks.
Great, thank you, guys.
Great. Stop share and leave meeting.